Hello, everyone, and welcome back to our Phillip Trading Podcast. My name is Liao, and today we have William with us. So, William is our product specialist and a senior dealer with Phillip Capital. How are you doing, William?
Oh, very good. Very good. Thank you. Yourself?
I'm great as well. Thank you. Yeah. So today, William will discuss about some of the topics. The topic for today is what should we expect from US earnings season amid market uncertainty. So as you all know, it has been a bumpy ride for the US stocks market with multiple factors, such as the red hot inflation, robust labor market, corporate earnings season, and a bleak market outlook for 2023. So all these factors has clouded the market sentiments. So what can we expect from this round of corporate earnings season? So William, yeah. So what can investor expect from this round of corporate earnings? Is it good or bad?
Okay. I think it will be a mixture, means there are some good and there are some bad, definitely. Okay. So previous quarter, if you look at our previous quarter earnings, right, there are most of the earnings reported are actually quite bad for majority of the companies in the United States. So the analysts, they generally lower their earning expectation this quarter. So this allows the companies to meet the earnings expectation easily as compared to the last round. Okay. So when we are trading the US stocks market, right, be careful to chase into stocks that gap out due to very good earnings. So the share price, if you ask me, I think they might not be sustainable. Okay, one of the example recently will be definitely Netflix. So if you look at Netflix share price, right, it has gapped up more than 10% recently this week, last week, due to better than expected earnings. However, if you look at the chart, right, of Netflix, it is still trading below the 200 days moving average. So this generally shows that although the earnings is okay, the share price go up, but it's still trading at the bearish trend. Okay, so be careful when we try to chase the good earnings company. Okay, so the reason why we are seeing share price rebound from its low is due to oversold. It's not really be like, okay, the market is the market is strong, the economy is strong, but mainly due to oversold, in my own opinion. Okay, so if you look at the three main indexes, right, the Dow Jones, the Nasdaq, and the S&P, they have been extremely oversold. The correction has been going on for the past 60 to 70 days, non-stop correction. So after 60 to 70 days of correction, a rebound is like a totally normal. It has nothing to do with good earnings and stuff, but just a very technical rebound after 70, 80 days of correction. Yeah, that is my own opinion for the recent rebound as what we have been seeing on Friday closing.
Okay. Yeah. So yes, indeed. So for those investor who try to catch those companies with good quarterly earnings, yeah. So you have to take note on this technical rebound. Okay. So next questions to William. So do you think we have seen the worst for the earnings, or investors should continue to expect bad earnings in 2023?
Just my own opinion, I think we have not seen the worst yet, okay, because the interest rate in the United States have not reached a peak yet. So aggressive interest rate hike will usually increase the borrowing cost for the companies, okay, increase the borrowing cost. So majority of the technology stocks in the United States are and usually high interest rate will make household spending power reduce, which lead to lower demand and the so-called demand destruction. Okay, so uh, recently, I think just 2 weeks ago, chief executive of JP Morgan Chase, he predict a recession in United States within 6 to 9 months. So some big companies, they are already giving signal that of the market recession by putting a break in their investment and also in their hiring. So one of the companies recently is that FedEx. The FedEx, they predict a slower demand for their shipping services in 2023 and is going to cut majority of their investment and also to freeze their hiring. Another one, which is Samsung, they actually issue a preliminary revenue and profit numbers for the third quarters that were below expectation. This is a sign of slowing down in demand globally. So Google, Facebook, and other technology giants, they also announced a hiring freeze. So they are not going to hire any more new staff at the moment. So all of the above incidents actually point to only one thing, which is a slowdown of business environment in the United States in 2023. Yeah, so I think overall the worst we have not seen yet.
Okay, yeah. So for those traders or investor entering next year, 2023, please take note on the above point mentioned by William. Okay, so next questions to you. Which companies in the US do you reckon will have a defensive earning from the upcoming economic slowdown?
Personally, I think consumer staple sectors are more resilient towards economic slowdown. So I personally favor the big consumer staples companies like the Coca-Cola, the Walmarts, the McDonald's, these kind of companies. So in the past, if you look at the previous recession, right, consumer staples related companies have proven themselves to be resilient during recession for their earnings, right? I'm not referring to share price, but refer to the earnings. However, investors should focus on finding consumer staples companies with very, very strong brand name and the so-called goodwill, and have the ability to raise their selling price based on the cost of input. So if their production cost increase, they can just easily pass down the cost. So some of the companies will be like Coca-Cola, McDonald's, this kind of fast food or soft drink, the soda drink, they usually have that ability and the power to pass down the cost to the consumers.
Okay, yeah. So let's see how these consumer counters will perform moving forward. Okay, yeah. So last questions to you, William. So do you think the share price of the companies that you mentioned have bottomed out already?
We are definitely still in that high inflation cycle era. So the interest rate, I think, have not reached a peak yet. So with this, I reckon that the market in general have not reached its bottom. So how can we measure the bottom? So my personal way, I have a very good way to measure whether the market has bottoming it or not. Which is we look at the MAN index. So as long as the MAN index, right, it drops more than 20% in a single month, it can be a signal that the market has almost reached that bottom because of the fear. So what does it mean by a 20% drop in a single month? So that means that from the first of the month, like 1st of October until the last business day of October, that we call a single month. So as long as we see indexes, the major indexes drop more than 20% in a single month, that could signal a bottoming stage, because I believe most of the retailers, right, they won't have the guts, they won't have the holding power to hold whatever they are holding if the index plunge more than 20% in 1 month. So just pay very close attention to this particular incident as a signal for you to just buy anything. Whatever stocks that you want to buy, wait for this particular signal. Wait for US index to drop 20% in 1 month time. Then go for it. I think the bottom won't be far from there. So I think this is the best way for us to judge it. So don't be afraid to buy on fear, but buy it wisely. At the extreme fear, without seeing the extreme fear, don't try to go and bottom fish it lah. Yeah.
Okay, yeah. So for those who wish to kind of predict or sort of catch the bottom of the very low share price, do take note on the 20% drop of the indexes in a single month. Okay. So yeah, so now our podcast has come to an end, and thanks William for the wonderful sharing to guide us through about the US season during these uncertain times. So for our audience out there, if you wish to trade US stocks or US indexes, feel free to drop us a message, or you may directly contact our representatives to know more about all of our ongoing promotions. If you are interested to trade US shares, the account opening of stocks trading account with Phillip Capital is totally free now within a limited period only. Okay, so please do contact us, and our representatives will be in touch with you very soon. And with that, that's the end of our podcast for this week. And happy trading, everyone. And thank you, William. Bye bye.
Bye bye. Thank you, Liao. See you again next time.
See you.